my opinion is that given what the Fed has done, they're killing deposits, they're killing money with QT. M2 is coming down in the United States. That by definition is deflation. Okay. Now add to that, and this is a topic we'll get into, but with all the stress going on in commercial real estate and all the stress going on in banks, and banks are basically in a position where in survival mode. They're going to lend less because they have less to lend. They're going to lend at harder, credit terms. They're going to lend at higher rates. All of that means less credit availability, which again is also going to mean less money available into the system, because banks, you and I and banks create money just the way the Fed does. If you and I go get a loan, we created money. Well, if you and I go pay off a loan, we destroyed money. And so I don't see money creation. I see money destruction. I personally think that we could see, however the Fed wants to measure it, they always change the goalposts, but CPI, PCE core, now PCE super core, and then I don't know what price of bananas. I don't know what's next. I think all of it's going to go down. That's what I think we're going to go into deflation, and that's when it's going to get real, because the Fed is terrified of deflation because that's far less controllable than inflation. Okay, so they're trying to bring inflation down. They're doing that, right? They're making it more expensive, borrow money, all these different things. If prices start going down, they can't make you and I buy anything. They could take rates to zero. They can, as they did in 2021. And at some point, you and I could just be like, nah, prices are going down. I'm going to wait. I'm going to wait. I'm going to wait. I'm going to wait. It's an uncontrollable beast. That's why central banks have chosen this magical 2% inflation target, because it's not zero and it's not negative. Because if it goes negative, they can lose control, as they did during the Depression, and people just will stop buying, stop commerce altogether. And that's when businesses fail and people get laid off and you have massive. So that's my fear, is that's a possibility. If you look at, again, if you go by a monetarist economist, if money supply is going down, and Keynes would tell you the same thing, you got to have deflation. So this is going to be the test over the next year or two.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Randy Woodward, who's Managing Director in the Fixed Income Capital Markets Division at Raymond James Financial. So Randy, thanks so much for joining the podcast today.
Hey, thanks for having me. I look forward to it.
Yeah, and I'm looking forward to it as well, because I guess there's been quite a lot of uncertainty recently, and this year has been one of those years where just so much has happened. So I guess if we look at what's happening today, can you just give us a brief overview of what you're currently watching in the markets and the economy?
Well, so I tell you what I do, so everybody has an understanding. My view of the markets. So as I told you earlier, I worked for Bloomberg from 88 to 95. And a lot of people don't even really know what Bloomberg is, but it's basically a financial analytics system that started in the early 80s by Mike Bloomberg and was mostly focused on fixed income. That's how it started, bonds, right? And so when I was there as programming and sales, most of my efforts were in bonds. And now it does everything: foreign currencies, equities, oil, whatever you want. It's amazing. But when I left in 95, I went and I sell bonds to banks and credit unions for the most part. Now I got some insurance companies, municipalities, but mostly what I've done my whole career is focus on banks. So obviously my purview of, market situation, given all the bank failures the United States has had in early this year, I'm seeing this stuff in depth, and I have in-depth knowledge in that area. And so that's kind of and that's what really got me getting into some of these podcasts, because it's the ignorance that I've seen in media has been astounding to me. So anyway, that's what I do and where I come from and what I see, right? So I think it's kind of fascinating to me what's going on in bond market, equity markets, and everything is trying to figure out, what's coming. And obviously, I'm sure you've talked about the inverted yield curve, where, short-term rates are much higher than long-term, which doesn't happen that often. But what that really is that, and this is my point of view as well, is that, look, this isn't going to last. These higher rates the Fed has put on us and other central banks, it's not going to last forever. They're going to break things, and which they're already starting to break. We just saw these massive bank failures. Those are broken because of what the Fed did, in my opinion. And we could talk about that more in depth as well. But eventually they're going to have to lower rates. So when a bond market knows that, then they want to lock in rates now and in longer duration, because they know what's coming. And that is things breaking, a recession, probably Fed panic. I don't know how low they go with rates again, but they're going to be lower. So that's the biggest market in the world telling you, and this is money, skin in the game. They're telling you this is where we think things are going. I don't do equities. I don't understand the equity market that much, but to me, they're just whistling past the graveyard, and it's rather quite amazing that how resilient the stock market has been, even through all those bank failures. It's like it never happened. So that's my general kind of view of the whole landscape right now, is bad things are on the horizon.
Yeah, and you're saying, is that not properly being priced into, I guess the bond market, or is it being priced in?
It is the bond market. I mean, that's why you
Yeah.
have an inverted curve, right? A pretty viciously inverted curve too. Um, and again, I mean, it's a hard concept for people. It's really interesting. A lot of people don't understand. To reiterate, why would I go into a 10-year? I'm going to actually pull my Bloomberg screens up so I could speak on with exact yields. So you got, why would I invest in a 10-year at a 421 right now when I can go into a 6-month US Treasury bill at 551, right? It makes no sense. To be sure, so everybody understands, the reason I would do that is because I know, or I feel that in 6 months or maybe a year or even 2 years, that bond's going to mature and my reinvestment yield is going to be much, much, much lower. So I would rather lock my yield in at 421 right now, knowing that most likely in the next 6 months, year, 2 years, my reinvestment rate on the short end is going to be well below that, right? So again, when you have that in a massive, massive market, way bigger than equities, lots of skin in the game all over the world, that tells you that, and they've always been right, by the way. The bond market's always been right on this. Now, timing, not so sure. We don't, it's probably gone on a lot longer than I thought it would, but the stock market has been very resilient. And it'll be interesting to see if something can break the stock market. And quite honestly, I'm a believer that that's why the Fed has been able to stay higher for longer, is because the stock market hasn't reacted. If you got a stock market crash, if you started seeing this, as I always say this on Twitter, I mean, throw in some limit down days on the Fed's desk, they'll react. They will. But as long as the stock market doesn't react, it seems like they're just going to keep it the way it is right now. So it's almost like a great game of chicken. We'll have to see what happens. We're going to learn a lot in the next year.
Yeah, and how have the banks been faring? Because as you said, there was a few banks that sort of blew up, uh, a few months ago, and there was lots of focus about unrealized losses on some of their bond portfolio because interest rates went up and the value of their longer duration bonds went down. So we've heard all this talk about Bank of America having massive unrealized losses and all these other companies. How are they faring? Are they going okay?
Uh, yes. So a few things on this. I'm pretty passionate about this subject, obviously. So let me start off with, if you hear somebody say, and you had certain TV personalities that would say this, financial media personalities, you even had a couple Fed presidents say this, that, well, these banks bought bad bonds. That maybe is the dumbest thing in the history of finance that I've ever heard in my life. Because it's so not the case. As a matter of fact, uh, most banks have bought really, really, really good bonds. Most banks have bought They buy government-backed securities. So they buy U.S. Treasuries. They buy agency-backed, so Fannie Freddie. These are all, maybe not explicitly with Fannie and Freddie, but implicitly they are absolutely backed by the United States government. Those are not bad bonds. They bought too long duration. No, that's ridiculous too. This is just bond math. Anybody who bought bonds and who had to buy bonds basically in 2000, well, over the last several years, but particularly in 20 and 21, had to buy at the lowest yields in the history of man. I mean, they're, zero bound, right? And if rates go up, those bonds are now all at a loss. If you had to sell them today, that's the key thing. If you have to sell them, yes, you got huge losses because that's how the math works. And I don't know if maybe how many people really even understand bond math. It's really simple to me because I've been doing it my whole career. But, it's pretty simple. Let's say, I buy a bond and it's got a 1% coupon. That's my return. Now, back in 20 and 21, that's outstanding because there was negative yields all over the world, right? So we get 1% return. We got a 1% coupon. We get 1% a year in income. Well, if all of a sudden you can go buy a bond at 5%, is anybody going to buy my bond at par for a dollar for dollar? No. So how do I make up for that? Well, I have to sell it to them much cheaper. Let's say 85, 90 cents on the dollar. That way, if they buy it at 85 cents on the dollar, they're going to get par back when the 100 cents on the dollar when it matures. That makes up for that small coupon that I'm getting. It basically is just it rounds it out to a 5% return, makes it equal. Well, that's just, again, that's bond math. That's not a bad bond. That's just what the Fed did to all bond values by taking rates up as aggressively as they have, right? The only reason it can become a problem for any bank is if they're forced to sell it. And that's what happened with Silicon Valley. They were in a forced position to recognize losses, and that was advertised, and it got to their uninsured depositors, probably a lot of insured depositors too, and the money flew out dramatically. And is so if that had not been the case, if you're not forced to sell, you just need time. Time heals. So if my bond today is worth 85 cents on the dollar, when I get to maturity, whenever that is, whether it's a year from now, 2 years from now, 3 years from, it is worth par. I will get par back. So banks just need time for all these unrealized losses to go away. Okay. And let me say another thing. It's so funny when they say, oh, they bought bad bonds or they bought too long a duration, blah, 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 blah. Well, let's go back to 2021 when unrealized gains were at the greatest size in the history of banking, because all the bonds they had bought when rates were higher were now worth so much more because current rates were so low. I didn't hear anybody saying, oh, they bought awesome bonds. They bought terrific duration, so it doesn't make any sense to say, and by the way, they didn't. It's just the math helped them in 20 and 21. When rates go down, the math helps. When rates go up, the math hurts. But with time, you always go back to just par, and the gains and losses come and go. So, Silicon Valley, Signature, First Republic, man, those are just plain old runs on a bank. No one can defeat a run on a bank. It just doesn't matter. And that's the real issue here is, and that's what I think the Fed understands this, central banks understand this with time. And that's, this BTFP program, this bank term funding program. It's interesting, I made a comment on Twitter a couple of days ago about, we're going to get to the commercial real estate in this conversation, but there's some serious troubles there. And all I did was say, I don't know, man, maybe TARP 2.0 is going to bail this out. And I had all these people like mad at me and cursing at me. And I had to keep telling them, I'm like, the definition of facetiousness, you calm down. I'm not saying that that's the answer. I'm saying, is that what they're going to do? And it made me realize how little people understand this BTFP program, this lending program, is one of the most extraordinary lending facilities in the, again, it's unprecedented in human history, where I can take my bond that's at a loss of 10, 15 cents on the dollar, and I can go to the Fed and I say, hey, I need to borrow off this collateral, but I know I want to borrow 100 cents on the dollar. And the Fed is like, you got it. So that program is equally as extraordinary as the TARP was back in '08. So, but people that, these acronyms come and go, and this acronym, here's this new acronym, everybody's like, they don't realize what an incredible effort the Fed has made. And what it is that program says, hey, if you're in a position where you have to sell your bonds, don't come to us. We'll lend you the money, a full par amount of the money, to give you more time so you can hopefully slow down deposit outflow. And that program's up to 107 billion or something like that. It's massive. So yeah, that's what has gone on. And yeah, banks are still facing that. As long as they don't have to sell, it's okay. They'll be okay.
Yeah, and I guess this is all, and that measure that the Fed brought in, I think if I'm not mistaken, is for a year, and I'm assuming they can potentially extend those loans as well if they,
Yeah,
if the Fed can do anything.
the Fed can do anything. Okay, and that's what that program is. I mean, that's what it shows, is we can do anything. They're always going to sell it as a temporary program. My guess is it's going to be permanent. I don't think it's going anywhere. We'll see what happens. So, I cover a lot of banks. I got about, 50, 60, 70 coast to coast in the United States. The one thing, though, still sticking out there is there a stigma with using that program? So when banks are using this program, they are letting people know on their 10Qs, we are using this program. So far, I haven't seen any stigma to it at all, but half my banks are like, we're worried about it. So we'll see, if there is ever a stigma. I don't think there will be. And as a matter of fact, I will tell you, as all my banks are going through their regulatory exams, most of them are letting us know that the regulators are saying, use the program. If you need it, use it. And in some cases, use it, and regulators will do this. Go ahead and use that program to some degree, so we know how to use the program. We know that you have the collateral where it needs to be, so you can immediately access it if you need it. So that's what's going on in the regulators right now, is they want to prevent forced selling, because they know that can lead to more systemic risk in our banking system. So they're promoting, we have things called brokered CDs, basically issue CDs, for the bigger banks, issue more debt, this 100 billion or more type banks, get the amount of money you need. That way, if there is more deposit outflow, you won't have to sell anything. Right. So, yeah, that's, that's the incredible thing with the Fed, is that they solved the problem over a weekend. And by the way, Silicon Valley Bank would have been fine had that program existed before they failed, before they were seized. They could have just taken that collateral and they would have been fine. So, you lose 3 or 4 banks and before that program came out.
Yeah, it's interesting when you think about that. And it seems like what they've always done, the Fed have always done whatever they can to, prevent things lasting for so long, and these massive occurrences becoming systemic. And I think that's something they learned from 2008. But if we go, yeah,
Bernanke invented that. So little quick history lesson. So Bernanke became the chairman. I forget what year it was, 07, 08 or whatever. He was supposed to be the expert on the Great Depression, and he's written books about it. I've read them all, and he came to a conclusion. It's really interesting. It's really important for everybody to understand, because this is the world we live in. if you talk to guys, like, Liar's Poker, what's that author's name? I can't remember. Michael Lewis. I think that's it. He
Yeah.
wrote The Big Short, the movie, the whole thing. He's been on record saying, look, all markets are rigged. Stock market's rigged. And here is why I believe, to some degree, in a sense that's true, is that Bernanke came to two conclusions about the Great Depression, about how it should have been taken care of. And that is, one, remove soup lines, remove the visual of a soup line. When you're driving to work or you're driving to the store, you're driving somewhere, if you see people, lines out down the street, possibly friends, possibly even family, in a soup line, that is depressing, right? And if you're going to spend less, you're going to be more frugal in your life. If you see that, you're like, holy crap, man, this is ugly. So we've got to remove soup lines. Okay. And we've done that in the United States with these, basic, it's a credit card now. It's massive how many people are on food stamps. We call them SNAP program now, but we don't see it anymore. So that visual is removed. The other thing he said is you got to remove the visual of a crashing stock market. Okay. So how do you do that? Why do you do that? Well, he explained in his book, and this will make sense to everybody. Go into a small town anywhere. We all know them. And these little towns and rural, communities, they're sort of self-sufficient. They work with each other, deal with each other. They know each other, take care of each other. Go into that community and say, hey, how's the world economy doing? Or the United States economy or the British economy? How's the economy doing? They're not going to know. Not really. They're going to say, well, I don't know. Let me see. Let me look at the newspaper. Oh, shit. The Dow Jones, the stock market is crashing. It must be terrible. And what's that person going to do when they see that? As he says, they're going to get irrationally frugal. And when they get irrationally frugal, and that means basically, oh my God, I can't spend a dime. I have to save everything I possibly can. That makes the whole situation even worse, right? That slows the economy down even more. And so, with those two things in mind, removing the visual of a bad market or a bad economy, we have to take over. And that means we have to prevent a stock market sell-off. And when the stock market, you go back and look, anytime the stock market really started to sell off aggressively, the Fed came to the rescue and eventually turned it around. And that's the way it's been. Look, these massive bank failures in a normal market should have tanked the market. I mean, the market equity should have been like, holy shit, what is going on? This is insane. These are humongous. There's some of the largest bank failures in the history of the United States all at once. And the stock market kind of went down for a little bit. And they're like, Fed's got us. So BTFP, I don't know what the hell that is, but it sounds good. They're clearly got our backs. The Fed put. That's where we're at. I don't know how that ends, man. I don't know if the Fed. I don't know what this end game looks like. I just know enough to know that there really are no fundamentals going on in equity markets. It's all emotions. It's all the assumption that no matter what happens, the Fed, central banks, they got our back and they'll come to the rescue.
Yeah, and it seems like a lot of the things that the Fed have brought into play, as you said, it's more thinking that there will be a recession. At one point, they're going to start cutting rates, and then bond prices are going to go up. But then everything should be resolved. But I know a lot of people are talking about how maybe we're in a secular shift, things are changing, deglobalization, all these other factors are going to keep inflation higher for longer. And then maybe the Fed are going to have to keep interest rates higher for longer. So these bonds are actually never going to recuperate their lost value.
Well, no, first off, they always will recuperate their lost value. Okay, let's just make sure. I got to correct you there.
Okay, sorry.
The bonds, when they mature, they will give you back par. Okay, that has to be understood. So, and now again, we're talking, United States back. Now, look, if the United States fails on, doesn't pay on their bond, that's the end of civilization. I mean, the whole world owns United States debt. I mean, really, small countries can fail, but big systemic countries cannot. It's just no way. So no, the bonds will, with time. Look, to be sure, I, ironically, here's what's so funny about this conversation, or about what you're seeing, is that as long as a bank isn't forced to sell, this is a great environment for them, because every dollar that comes back to them, every bond that matures, gets reinvested at today's rates, which is way higher. And that means higher income. So every day, and it could be not just my bonds, it could be the loans. Every day, if they can mature a loan and uh, get a new loan at a higher rate, that's higher income. This is actually a wonderful environment for banks. You know, so, I even tell this to, and even board members of banks don't understand it. I'll go into them and I'll say, okay, what's your problem with your unrealized losses? And they're like, oh, well, we bought bad bonds. No, not true at all. You did. Think about that. These are board members of banks. It's scary. I go, no, no, no. Okay, well, let me ask you then. If rates went down 300 basis points and all of a sudden all your bonds were at a profit, would you be happy? Oh, yeah, yeah. Well, why? Well, because our bonds are doing better. No, they're not doing better at all. You've just changed the pricing. You're not going to sell them anyway. You're not in trading. So what you just did is you said, oh, I'm happy if rates go down, but now whenever you reinvest any dollar that comes in the door, you have to reinvest 300 basis points lower. Actually, you're hurting income. You're worse off. And that's when the light goes off. They're like, I'd never thought of it that way. You're right. And so we're actually if we can be steady, and with time, everything will be okay with these banks. It'll all be fine. Um, what causes the Fed to cut rates? The bond market says they're going to have to. We'll see. And look, man, money supply is coming down dramatically. That's a new experiment we haven't done since the Depression. So there's a lag to everything they're doing, and you're starting to finally see that in financial media. Is they're starting to admit there's a lag to this. We might want to be patient here. And I think even some of the Fed chairman or Fed participants yesterday, there was like a dozen of them speaking yesterday. I think several of them have said, there's a lag to this. And I think they're trying to, I think they're starting to promote the idea that we're ready to stop. So, and what comes after that, when, I don't know.
Yeah, and maybe going back to my first point, even though they'll still get their whole principal, they'll miss out on that extra 300 basis points of coupon repayments over
Excellent
these
point. Excellent.
coming
Very
years,
good point, Anthony.
especially their long duration.
And that's what bums me out, because right now, I mean, I sell bonds. That's what I do. And right now, nobody has any money to invest. And that's, because money has come down, deposits have come down, money supplies come down. They don't have any money to invest. So they can't take advantage of it, right? They really want to, but they simply do not have the money to do it. And given everything that's gone on with all these failed banks and this focus on unrealized losses and they're going to hold more cash just in case. That's what the regulators are going to want to see. Make sure you've got a buffer. That way, if all of a sudden you lose deposits, you'll be okay because you got the cash to give them. You won't have to borrow the money. You won't have to sell any securities. So, yeah, I'm afraid what you just said is going to be the reality, is that when finally banks are in a position to invest and have more money to invest, the Fed will have cut rate 300 basis points, and all this opportunity is lost. You're absolutely correct, and that's a wait and see thing. But unfortunately, I think that might end up being, being the reality of things. And the other thing I fight, as you can imagine, is trying to get even my clients to understand, if they do get money, they're looking at the 3-month, or like I said earlier, the 6-month at a 550. They're going to want that. And I'd be like, yeah, you don't want that. Why don't you go with the 5-year at a 430? And they're like, no, my God, it's so much less. I know, but rates are going to end up being lower in 6 months. And they're like, oh, I don't know. These guys on financial media are, higher for longer. I think the rates they might even go to 6. I'm like, this is the battle I'm going to have. And a lot of these investors and a lot of these, any bond investor is going to make these mistakes. They're going to go short and go for the near term yield. And then what it's going to end up happening is they're going to realize, oh God, my reinvestment rate is 2, 3, 400 basis points lower than what it was when I invested a year ago or whatever.
Yeah. So your base case is that maybe it's going to go back to the norm. The Fed's probably going to have to tighten. We're not going to see higher inflation, higher interest rates for longer. Is that
I
what you
don't
think?
know. I mean, look, man, I've
Saying?
been wrong. I do think from the very beginning, inflation, I believe, is transitory. It is supply and demand. That's just, and to me, it has been coming down. And there's little cool little metrics that I've seen that are really fascinating. So the Cleveland Fed did something really neat a few years ago. They rent, is a huge part of inflation. Housing costs and its rent is how they measure that, and it's been very high. Um, it's been coming down, but what the Cleveland Fed said is, it takes time for rent to come down. And by the way, we're also talking pace of change, right? I should say, and that's something Bernanke is, or I'm sorry, Powell is very adamant about. When somebody says, in your effort to bring prices down, he always jumps out of his skin. He's like, no, 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 no. I'm not trying to bring prices down because that's deflation. Now, he won't use that word because he'll burst into flames. But he says, I'm trying to bring the pace of change down. I'm trying to bring inflation down. So when I say rents down, what it is just bring down the increase that we've seen. Well, the Cleveland Fed said, well, there's a lot of existing rents out there. A lot of it, it takes time for the repricing to work through the system. So what they started measuring a couple of years ago is new rents. What's new pricing, brand new rents? Where are those? Those just went negative. Those, for the first time, and I think since maybe '08, it just went negative. That's an advanced look at where housing inflation is heading, rent inflation is going, is as those prices adjust, they're got that rent. If the new rents aren't going up, the old rents are going to have to stop going up as well. And that's just going to take time. So I personally think I'll make this prediction that you brought up something interesting earlier is, would you say global decentralization? And I think that is effect, and that certainly is going to lead to higher prices. But again, we got to be careful with pace of change versus just nominal prices. My opinion is that given what everything the Fed has done, they're killing deposits, they're killing money with QT. M2 is coming down in the United States. That by definition is deflation. Okay. Now add to that, and this is a topic we'll get into, but with all the stress going on in commercial real estate and all the stress going on in banks, and banks are basically in a position where in survival mode, they're going to lend less because they have less to lend. They're going to lend at harder, credit terms. They're going to lend at higher rates. All of that means less credit availability, which again is also going to mean less money available into the system, because banks, you and I and banks create money just the way the Fed does. If you and I go get a loan, we created money. Well, if you and I go pay off a loan, we destroyed money. And so I don't see money creation. I see money destruction. I personally think that we could see, however the Fed wants to measure it, they always change the goalposts, but CPI, PCE core, now PCE super core, and then I don't know what price of bananas. I don't know what's next. I think all of it's going to go down. That's what I think we're going to go into deflation, and that's when it's going to get real, because the Fed is terrified of deflation because that's far less controllable than inflation. Okay, so they want, they're trying to bring inflation down. They're doing that, right? They're making it more expensive, borrow money, all these different things. If prices start going down, they can't make you and I buy anything. They could take rates to zero. They can, as they did in 2021. And at some point, you and I could just be like, nah, prices are going down. I'm going to wait. I'm going to wait. I'm going to wait. I'm going to wait. It's an uncontrollable beast. That's why central banks have chosen this magical 2% inflation target, because it's not zero and it's not negative. Because if it goes negative, they can lose control, as they did during the Depression, and people just will stop buying, stop commerce altogether. And that's when businesses fail and people get laid off and you have massive. So that's my fear, is that's a possibility. If you look at, again, if you go by a monetarist economist, if money supply is going down, and Keynes would tell you the same thing, you got to have deflation. So this is going to be the test over the next year or two.
Yeah, it'll be interesting. I guess if we bring other countries globally, and I'm not sure how much focus you put on them from your own sort of bond analysis, but I would assume that UK, Europe, Canada, all these other countries are going to start cutting rates a lot quicker because of the challenges they're having with the economy, their mortgages being sort of variable, all these other factors, and that might make this issue even further with a very strong dollar. And as you said, you could get deflation, and if China continues to have concerns, and that could
Yeah,
be a massive factor moving forward.
I think so. I mean, I again, in the grand scheme of things, I mean, it's just quite simple. If you're destroying money, how can you continue to have inflation? It just doesn't work that way. It's not. Yeah, and yeah, you could see inflation in pockets. I mean, you could. I'm trying to think of whatever latest gadget. iPhone can see inflation because everybody's got to have one, and they're going nuts. But that's one item. On the whole, if there is less money available, you got to have deflation. I mean, that's just how it works. Um, and that's coming. I think that's coming politically. I think everybody's had to fight inflation, and I think I don't know. Again, I follow mostly the United States, but I think your inflation in Europe has been much higher than ours has been recently. But I still think that all is going to change very quickly, and it'll be really interesting to see how central banks react, and they'll do it in a coordinated fashion. Um, I think that's the other thing people should understand, that these central banks all talk to each other. They all coordinate. So that's why they use the same words, transitory. So all of a sudden, every central banker is using that odd word. So we'll see what happens. But I think you're right. If you start to see other central banks cut before the United States, that's a damn good. They all know that. That means the Fed will probably follow shortly behind them.
Yeah, makes sense. So if we go, something that you've mentioned quite a few times, commercial real estate, and you think it's actually going to be a massive challenge moving forward. And I think before we even talked, you said that you think it's quite misunderstood about the impacts that it will have. So I'm not sure if, you can go further into that and what impacts it could
Yeah,
have.
here's what's misunderstood, and fortunately, it isn't necessarily quite my world. There are products, securitized commercial real estate that I sell and whatnot. But how commercial real estate is priced, I didn't really understand it until about a year ago. When I had a friend here in Nashville who's a huge commercial real estate investor and developer. He called and explained it to me. And because he saw my emails, he sees financial media, and he was like, look, no one understands the real problem here. He goes, let me explain it to you. You have to, first off, as an individual, as you and I and your guests, get out of your mind that, I want to live in the Hamptons, okay, in New York, or I want to live in the nicest part in London. It isn't it isn't the desire to be there. Commercial real estate is income flow. End of story. Now there is some, is my guys will call it trophies. So there are some buildings in the United States that are just so popular and amazing, people want them. Okay. But for the most part, it comes down, how much income does that property generate? Well, that's how you figure out how much the property is valued at. And so in 2021, a lot of this stuff refinance. And there's a thing, and this still a little murky to me. And it's murky because I think even the guys who are in the business have a hard time understanding how it moves as well. There's a thing called a capitalization rate. The capitalization rate, basically, it should move with yields. It's a yield. How much yield do I want out of this property? Okay. So a lot of these cap rates were 3% back in 2021. So what that means is the way the math works is based on your net operating income, how much income you're bringing from that building. And I want to get, it's just like a bond, basically. I want to get 3%. Your building, I value your building at $2 million. Okay. That's how the math works. If I think it's about 100,000 a year, you value it with the 3% cap rate. I believe that's right. I value your building at $2 million. Okay. So now I'm going to give you a loan. It's 70% of loan to value. It's $1.4 million. Okay. All right. Well, you get that loan. The loan comes up in 5 years. They're coming up right now. Okay. The 2017 loans and 18. Now the cap rate is, let's say, 6%. Okay. Right. Yields are higher. I have to, if I'm going to lend you the money, I got to earn more on that, because, or else I'll put my money in the bond market. Well, now with this new cap rate, if my net operating income has an increase, if it's the same, and in many cases it is, particularly, that's actually a good scenario. If you can imagine, if you're in office real estate, net operating, your income is less. And so that just makes what I'm about to say all the worse. But let's say it's the same. Well, the way the math works is that building is now worth far less than 2 million. Okay. So everybody's like, oh my God, they're going to have to refinance it, whatever percent. Their loan was at 4.75. Now it's going to be 7.75. Can they do that? Can they do that? That's going to be hard. That's the only thing you hear on financial media. That isn't even the problem. Here's the problem, is that my building now is only worth $1 million. So I can only get a loan for 700. If it's still 70% LTV, which it's probably not, but let's assume it is, I can only get 700,000. Now my loan that I have at $1.4 million, and maybe I paid some principal down on it over. So let's say it's $1.2 million, whatever. I can only get 700,000 right now, and I have to mature this loan. What does that mean? I have to show up with 500 grand. Let's say I got $1.2 million left on the loan. I have to show up with 500,000 in cash, in equity, in order to get my 700,000. That is the problem. And it's not just, that isn't commercial real estate. That's all commercial real estate. That's not just office. Office is much, much worse than that. That's what the real problem is. So there's a stat I heard just a couple days ago on a podcast. In the CMBS world, where this can be monitored, the commercial mortgage-backed securities. So with all these properties that have been securitized and sold as securities, 84 in August, 84% of the loans that came up for maturity did not mature. They were renegotiated. Okay. The lenders went in and said, okay, you can't mature this bond. You can't refinance this loan. You basically make this loan go away as it's supposed to. So whether you buy it out or you refinance it or you sell the, whatever. So we're going to renegotiate the terms for a period of time. Okay. Our regulators came out in force and said, they promoted this idea, renegotiate for about a year. And they gave all these examples of where, why this is a good thing and how to do it. Put off reality. We call it extend and pretend. So that's how many of these loans, 84% in just 1 month. And that means every month it's going to probably get worse or accumulate. They can't refi the loan. So all they can do is renegotiate a little bit. And that can't go on forever. Okay. Our regulators will put an end to that at some point, and the loan will have to go away. When that comes, I don't know. That's the big guessing game. But try to understand that is the biggest problem. Now, hopefully, I've explained that well enough that that's the kind of holy cow moment here. Is like, what are they going to do? Nobody knows. Nobody knows. I think the regulators hope that if we can stall it, extend it, in a year from now, we will have cut rates a bunch, which is going to certainly help that situation, right? If I cut rates and my cap rate goes back to whatever, my building's worth more, maybe we can get out of this. I don't think that happens. I think even if we go back to where shit, if even if the Fed goes back to zero, which I know they do not want to do again, even if they're forced to, banks aren't going to, they're not going to, be fooled again. They're not going to do 3% cap rates anymore. They're not going to do 70% LTV anymore. They're not going to do long duration lending anymore, which they had gotten a little bit, that's probably where they did get a little too aggressive. It is going to be so much tighter, so much harder. All these loans that exist, there's going to be I think, massive failures. And those properties, they will get bought. One of these guys on this podcast said this is going to be a once in a lifetime opportunity in commercial real estate. Okay, that sounds great. Well, that's because you're going to see once in a lifetime defaults. Okay, you can't have a once in a lifetime opportunity for the guys with cash, the private wealth funds and the family trusts and whoever's got money, PE, without somebody taking it on the chin. And it's going to be whoever ends up owning these properties at 200, 300% over where they're actually valued. Losses have to be recognized for somebody. I don't know who's really, I don't know where those losses are coming from yet. Certainly many banks are going to feel it. And I've been clued in a little bit. I've got one credit union that told me just yesterday that we are starting to really take it on the chin. And, so the cracks are forming. But that's the problem. That's the issue with commercial real estate. Hopefully I explained it well enough.
Yeah, it's interesting how you explained it. I think, using your calculations, if someone were to refinance and put that extra equity in, it would actually be more equity than the total value of the asset currently
That's true
at
too.
current valuation. So then the
That's a
challenge,
good point. I hadn't thought of it that way, but you're
yeah.
100% right.
And then if we look at, and I think BlackRock's done this recently, I'm not sure where they did it for a certain commercial real estate property, because for them, it's like, well, we're not going to go negative equity. We may as well walk away from it. And it
That's an
seems like, yeah,
excellent point. That's a really good point, Anthony. And that, I'm glad you brought that up. So this is another thing that my friend here in Nashville, Tennessee, told me, which if anybody in the world probably knows, it's like Dubai. I mean, we've grown so dramatically over the last 10, 15 years. It's been extraordinary. I mean, literally, I used to count 25, 30 cranes in downtown Nashville. And so it's been crazy. But here's an interesting thing that he explained to me. He said, look, when you see these financial media cover these high profile failures, BlackRock and whatnot, he goes, those are all non-recourse loans, meaning they're one-offs. And whoever the lender is, they only get the asset. They don't have any claims to any other assets. Most of commercial lending in the United States and in rural America is with recourse, meaning you have to put up other collateral. You got to put up other your home, other buildings, other assets. That way, or personal guarantees, your own personal checking account guarantees and things like that. That way, if there is a problem, the bank can recover their losses from your other assets. So if you can fathom when this starts to hit, this is far uglier for people and for investors than it's going to be than what it may appear for BlackRock. They operate on a wholly different level. So when you see those examples, kind of ignore them. Realize that when other properties start, little of a strip mall or something like that, somebody is quite possibly losing all their assets, not just that asset.
yeah. I
That's
can
a
still
scary version.
imagine that, I'm assuming there's LLCs and other things protecting people.
Mm-hmm.
So it's probably, if you think about the people who are probably going to lose out the most, it would be those lenders, I'd imagine, during such a situation, if they're left
Yeah.
with that asset and they can't recuperate anything else. Um, so then if we link it back to 2008, I'm assuming that you probably don't think it's going to be like that because regulators, and it's obviously quite a lot smaller market compared to what MBS was back then.
Um, I don't know. I really, it's always different, Anthony. It's never the same. You can never compare. Um, and again, it's going to be emotionally, it is when you start to see the cracks and the bankruptcies and how do investors react, you just don't know. But again, we've seen we've seen some extraordinary steps by the Fed, and so they're scared. So they're clearly, their concern should concern everybody with these more programs and loosening of standards, to get money from the Fed and other institutions. I just don't know. I don't, you certainly hope not. I mean, hopefully we learned something back then, and you know, a lot has changed since then, but I just don't know. We'll have to see. I wouldn't, I wouldn't assume that it's not going to be that bad. This whole soft landing thing, which by the way, if you notice, everybody in every central banker uses it now. So again, I don't know who, by the way, that's something, if you read Bernanke, you know, he's an interesting dude. He was very, forthright in his books. He talked about a lot of things to me with extraordinary hubris. And one of the things he talked about is, he joked about it in his book, which is the title of Amazing Hubris, The Courage to Act was the name of his biography, which just makes me want to throw up. But he joked about how many emails would be traded on choosing a single word that was going to go in their press release. And they would email each other, and they would talk around the world to different people. Like, we're going to go with this word. We're going to go, and then we would change the word. We'd come up with a different word. And it was almost comical. He treated it almost as a comical thing, like, the marionette, with the markets, I'm going to choose the right word and the right string to move markets around. And he would even go to say, when markets reacted the opposite of what he intended, he would literally say, the markets got it wrong. They were wrong. And then we had to go fix it. We had to come out with this program to fix what they're wrong about. And it's an incredible thing. So yeah, but I think this soft landing thing, good luck with that. That's an interesting, trying to land on an aircraft carrier, we'll see.
Yeah, it's fascinating to hear stories about Bernanke for someone who got so much wrong and then trying to act as if everything went well. But
he's a I think people are going to go back in the end and probably study him a lot more. He changed things dramatically. When I worked at Bloomberg, I helped this a company called Stone and McCarthy, which were two research guys out of Merrill Lynch who wanted to start their own research firm. And Mike Bloomberg gave them space in our office. And because I was in programming, I helped them. And I remember when the Fed would come out with their press releases and whatnot, I mean, they would go berserk with what was in there because nobody had a clue. Nobody knew what Greenspan was going to say. And so they're all around there and they're typing furiously. Oh my God, he said this, he said that. And I mean, it was like, Bernanke took all that away. He didn't believe in that. He believed in forward guidance. He believed in going into the press, managing markets. He brags something like 95% of monetary policy is just words. It's just our words. It's our guidance. It's what we say. All these guys out, you would never see that. 12 of them, I think, maybe eight Fed FOMC members out in the press. I mean, that would never have happened under previous chairman. The only time you heard from them was when they were in front of Congress. And even then, they were smart enough to say a lot, yet say nothing, because that's the way they wanted it. They didn't want to manage markets. That wasn't their job. And here comes Bernanke, and he put that in place all around the world too, by the way, that we got to manage markets. We have to do that. And we do it with forward guidance. We do it in a coordinated effort because we know better than markets, and we can't let them trade irrationally because it'll scare people, and I don't know how long you want to go, but you sent me an email. You said one message to take away from our conversation. So I've got one ready for you when you're ready to end the conversation, but it has to do with Bernanke and what happened in 2008. There's a huge lesson there, and people should study it.
Let's go. What's the message?
Okay. So there, I don't have it in front of me. I should have, I didn't bring it. There's a really neat book everybody should read. And I've been kind of mentioning it. It's a book called Rigged, which came from one of your guys, Anthony Verity, who is the finance reporter at the BBC. Basically, this book is about all the guys that went to jail for manipulating LIBOR. And for your crowd, and if you've got a big, particularly in Britain, because this metric was managed out of London, it's an extraordinary story of my opinion, central bank, but also, these regulatory agencies, the power that they have, and the politics involved, and how they pounced upon what I believe and Andy believes, and I think it's 100% true, a bunch of innocent guys to make a case for themselves to kill LIBOR, basically. And LIBOR was the most important metric in the world. It's the first financial metric in the world. And it was given to me when I first joined Bloomberg in 88, and particularly in 90, this is the most important thing to follow, because, and this is London interbank offering rate. Basically what it was is, how much do banks lend to each other? What are they charging? Okay. So banks all around the world, hey, I need money for a night. How much, this. Well, what the world did is said that is a really good measure of where rates are, where short-term rates are, 1 day to a year, whatever. So we're going to lend off that metric. Okay. So trillions of notional dollars are lent or traded off this metric for ever since it was created in 86 or something like that. Well, here comes what I want people to look at, and I'm going to do podcasts about this eventually. I've finished reading Andy's book, and I'll probably read it again. Is talk to people about what was happening in 07 and 08 with LIBOR that was forcing Ben Bernanke to act. Okay. When LIBOR started going higher or over treasuries, it's supposed to be risk-free rate. Okay. That's what LIBOR is supposed to represent. But when LIBOR starts to elevate above, say, US treasuries, well, that means there's stress in the system. That means banks are like, you know what? I'm a little worried about you. I'm going to charge you more for this loan. Okay. And what happened was, it was the Bear Stearns, when their subprime funds failed. And this is, a lot of your listeners, and maybe even you, maybe aren't really super aware, because you were probably very young in, 07. It's something to go study. That kicked off a worry. That kicked off like, holy crap, like, I'm worried I might not get my money back. I'm worried that you're Bear Stearns and you might fail. So when that happened, borrowing costs across the planet had to go up because LIBOR was going up. And the Fed is bringing rates down to try to cure an economy that's going into recession, yet the number one borrowing metrics is going up. So starting in August of 07, at least 24 times to October 08, the Fed was forced by LIBOR, the level of LIBOR, to act, to come up with our new acronyms, new programs, lower rates again, make the discount window more easy to use. And I've got it all on an email. I wrote this all out in 08 to all my clients. And now I realize, I look at my list, I'm like, this is a really interesting, valuable list, because it proves why central bankers had to kill LIBOR, because LIBOR was forcing their hands. Bernanke wants to be in charge of the marionette. He wants to control things. And it's funny, and Andy, I just only, he called me about a year ago. We did a Zoom because he saw me on Twitter talking about LIBOR, and he goes, you need to read my book. You need to hear my story. I've written a book about this. Anyway, that's my thing to take away, is go read his book. Now, his book, when I do when I'm going to do a podcast, hopefully with Andy, and hopefully some of the characters that are in that book, and hopefully some of the poor souls who were wrongfully put in jail. Um, there's a hopefully I'm going to connect the dots to say, here's why nobody said anything. Here's why no central banker. Here's why they probably supported what was happening to all these guys, is because it was collateral damage. We have to kill LIBOR. We have to kill it. And they did kill it. And the story goes on, but start with that book, and then keep an eye on me and you and whoever, and we're going to go further. But what it shows is the central bank's desire to control markets is insatiable. And to me, the killing of LIBOR proves that out. And they've all taken it. They've taken over this metric now. It's Sonia in your country. It's SOFR in my country. They now have full control of the metric that's now going to be used on lending all over the world. They have full control of it. They pretend like it's a market rate. It's bullshit. It is not. They say it's based off repo. Well, yeah, you control repo. So you have full control. That's the thing I want people to really pay attention to. And don't forget about LIBOR. Go back and study. What was it? Where did it come from? Why was it used? Why was it important? And I think everybody in finance, anybody interested in finance or in finance, should be educated on that topic.
Great message. And yeah, I'll have to go out and get that book. It sounds
you do. You
really,
need to read
really
it, man.
fascinating.
Yeah. And follow Andy on Twitter, Andy Verity. He's a damn good reporter as well. He's a good guerrilla reporter. I really, and he was involved in that whole situation really early on. And he knew early on in that whole case. I forget exactly when those guys started getting charged. It was years later. And that coincides with some other things we could talk about some other time that are happening, the creation of SOFR. But he knew pretty early, this sounds really weird to me. And but even on other topics outside LIBOR, he's just an excellent reporter, and he should be followed.
Yeah, great. Sounds good. So Randy, thanks so much for your time today. I really appreciate it. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Just on Twitter, it's at the Bond Freak, which is, I got that from a movie, but somebody called themselves a chemical super freak, Nicolas Cage. I was like, well, I'm going to call myself the Bond Freak. But so only on Twitter, and I have nothing to sell. I mean, I do it because I like educating. I was treated that way when I was at Bloomberg. I got a really, really unique education working for Bloomberg. And so I like educating. And I will tell you, Twitter is just so fascinating. I have access to you and people all over the world who are so willing to educate and so nice and kind. And it's just such a great platform. If you know how to manage it and stay away from the riffraff and ignore the riffraff, you're going to get access to some of the coolest, smartest, caring people in the world. So yeah, if you want to see what I have to say and see my conversations with other people and people that I follow, that's where you can find me.
Perfect. I'll put the link in the description below, but thanks again for your time.
All right, cool. Thanks, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.